Hi folks, Scott here, and this is the wrap for Friday, September 25th. So this is the daily chart of the S&P 500 index, and you see over here we finished at a new multi-day low. In fact, if you count them up, it's actually a new 10-day low close. So what I thought would be interesting would be to show you the results of fading gaps after a 10-day low close on a Monday. However, sample size is a little bit smaller and the numbers were roughly the same, so I loosened the parameters to show you the results of fading gaps after a 5-day low close and on Monday. And the other parameter is it must be above the 200-day moving average. Whoops, what am I doing? Wrong button. And there you go. Now this is using Gap Trading, my back testing tool, which, as a reminder for those of you interested, I had a couple webinars past couple weeks on it. The early bird special expires on Monday. Check it out on the website. In fact, let me show you where. Gap Trader, you can read all about it here. Same with the Range Trader. And you click the buy button and you can see the changes in pricing. Not inexpensive, but you know, what's the cost of having a powerful tool like this in one-on-one trading? Only you can judge the value of that. Many of our members have it, and I think have found it to be well worth it, but certainly not for those that are budget conscious right now. Whoops. So let's comment on this. 3-to-1 odds of gapping up after 5-day low close. 3-to-1 odds on this one particular pattern. When that 3-day low close was on a Friday, a 5-day low close was on a Friday. Using an end-of-the-day stop, very strong odds and profitability to the upside, and vice versa, not good odds nor good profitability when gapping up. Even if you got rid of this one monster loser for fading, it's still significantly negative. So clearly a long bias again. So the market keeps defying these long biases. Maybe it's trying to tell us something, but looking at 10 years of history, market has been poised to, or I should say, has been favoring the long side at the open for the last, I think, 3 or 4 days now. All right, let's look at what the worksheet showed this morning, because we gapped down to open below the low of yesterday, which was an up day in most indices, and opened in different zones, but we were opening in the UL zone, the UOL zone, and maybe even the UCO zone. You can see opening below the lows was a terrible setup today. Not good, and not all that great, but overall neutral between the close and the low. Nothing for unique day factors or unique patterns. Let me see how many of these open below the lows. So the white dotted line is what you're looking for and where it is relative to the red dotted line. So we opened below the lows. That made it a blood gap there. UOL zone for the Russell. Blood gap for the NASDAQ. Below slow, but in the gap range from yesterday. And then the Dow actually closed down yesterday and opened. Oh, that's wrong. Hold on. UL zone opened just below the red dotted line. So mostly blood gaps. And without even showing you the gap guides, you can see it was just a weak historical setup. It was still almost 40%. Finished positive by the end of the day, and every day is a little bit different. Looking at my worksheet, you see last night's wrap showed sort of neutral for a gap down, but on Fridays possibly a little bit of risk, but that was countered completely by the large gap. So overall neutral. That's how I put these two pieces together. Right? One was good, one was bad. Small sample sizes. Big picture was neutral. It's neutral. Down gaps on Fridays when below the 10 above a 200-day moving average, slightly weak. If the gap is large, which is what we had today, it's very counterintuitive. It's actually been a positive setup historically. You remove the 10-day moving average, it's really, again, positive. And Friday's one of these weird days where small down gaps are riskier and make less money over the long term, even though, and they're not that much higher win rate either, if any, than the large down gaps on Friday. So basically, I'll summarize the markets were neutral to weak for down gaps today. Mixed factors for fading down gaps, but mostly positive of large. And while large down gaps for price have been attractive, overall historically the data and expected win rate is too low for me to fade them. So I'll pass and wait for the range guides. And that's what I did. And let's see, the low of the day, 80, sold off almost 4 points. So you assume a tick of slippage, you would have had sold off 4 points with a 5-point stop. You would have barely survived, but you would have survived and finished positive at the end of the day. So technically this is a miss, but I'm fine with this because it certainly did not fill its gap, right? It just barely ended profitable by a few points. So it wasn't worth the risk, but the rest of the day was tough for me. 15-minute range guides. Look at the futures here first. Low breakout looked pretty attractive. 4-point target, 4-point stop, yes. I'm looking for 55 and 1.1, definitely yes. Some strong numbers there, neutral there, strong numbers. 3 out of the 4 futures clearly met my criteria. The spider confirmed, the diamonds confirmed. Qs were a little bit problematic, and the Russell was right at it. So I thought overall it was worthy of a half-side trade. Macro factors showed some risk factors as well for the ES low breakout. I went short at 1681, explaining immediately that this is one of the scenarios after the market stretched to the downside. You can get reversed and stopped out, and it's like I knew it was going to happen. It reversed and stopped me out for minus 4 points. That was frustrating. First hour guides came out. Let me show you those. High breakout favored in the ES, high breakout favored in the YM, leaning towards the high breakout in the NASDAQ, and favored the high breakout in the Russell. ETFs weren't quite as good. Spider did not confirm. Diamonds did not confirm. Qs, you could say, or not could say, did lean that way for sure. And Russell basically met my criteria too. So that was slightly attractive and had some more positives. Decided to trade half size on the high breakout, and I got triggered right there by 1 tick. And then I got stopped out right there by 1 tick. Don't believe me? Look at these levels. So the high breakout triggered at 1685.75. The low of that bar was 1681.75 to the tick. That was the low of the entire day except for that down thrust. So I was buffaloed on it before it finished positive by a point or so. Real disappointing. Unavoidable. Here's my thought process. While the data was pretty good, but not, or first off, on the low breakout, it was pretty good. It was also supported by poor data for the blood gap, right? The UL zone today, but we were stretched to the downside. I will admit I had in my head pretty good chance of running on down to the 20 and 50-day moving averages and filling some down gaps down there. But still, it met my criteria in the blood gap. I'm almost always going to take a low breakout. It didn't work. The high breakout, I traded for several reasons. One, the macro factors were pretty decent from the advanced studies. Two, we just had this reversal, so I wasn't the only one that had gotten short down here. Probably be some more stops up here. Thirdly, I showed you there was data that did favor large down gaps finishing positive on Fridays. And fourthly, I'm forgetting what the fourth factor was. I don't remember. There was a fourth reason I explained in the trading room. In advance, by the way, we talked about this at length. I thought I made a fairly compelling argument. I did a poll in the room, and it was overwhelmingly, I said, how many people think the high breakout will work? And it was something like 25 said no, and 10 or 12 said yes. So the majority of people that answered the poll in the room, we had about 100 people in the room, did not like my trade. I then asked the more important question, how many of you that said no are in the trade? And only about 5 of them. So there were at least 20 people that were pretty vocal and active in the room that did not feel compelled by my argument on interpretation of the data being strong enough to go long. So that sounds odd, but there's silver lining in that it just shows it's a good group of highly educated independent traders making their decisions. So and I say it all the time, there are plenty of people that make more money using our guides than I do. My secret sauce are the guides and the data that I share. So I wish that were not the case. I wish I could tell you I've made the most of anybody, and I do pretty well most of the time, but we got a great room. And they were right today, and I was wrong. So 0 for 2 there, did no other trades the rest of the day, and called it a day. So fortunately, they were half-size trades, and I've lived to trade another day, and we'll see what the market brings us next week. So there you go. Have a great weekend. Take care.